Hey everybody, Dave Bartosiak here on the Zacks Research Desk, and I'm going to go ahead and go through some charts here. This is TradingView. This is one of our partners on Zacks.com. If you pull up the interactive chart tab on Zacks, you actually could maximize it, and it will look a little something like this. We're going to start off with the S&P 500 to try to figure out what's going on. So obviously the huge move off the March lows. And then recently we've got sort of a triangle developing here. So what I like about this is obviously the huge move, but we're able to draw these retracements from these moves to give us an idea of potential support if these moves start to break down. So what I mean by that is we've got a little bit of support here at the 50-day, which came in start of June, and then again last week. But with this series of lower highs, should this break down, I just want to know some target areas if it does come back and reel back in. So 71.27 on the S&P 500 is the 38.2% retracement, which would be sort of a mild move lower. Really, this 50% is kind of intriguing to me because it's right around 7,000, and that was also where previous resistance was. So, and then you have the 200-day moving average also coming into play. So if we get some bad news, especially if some of this economic data doesn't come out the way that we want, we're going to start to see some deeper retracements. Could get down in the 7,000s on the S&P 500. Now, that's sort of that's the bear case. Now, what's the bull case is that it would continue higher, right? The market would continue higher, and we'd find our way out of this. So one trick that I like to use is, rather than the retracement, which is you take the big move and then you move in this direction, there's another mechanic of these Fibonacci levels called extensions, which basically mirrors those levels across that zero line. So you can do this relatively easy. All you have to do is double click on your fib, and then if you go over to style, now you could pick, right? You can pick these levels that you want to see. So since we're mirroring over that zero, we got to get negative with this. So like I said before, we were looking at the 38.2% retracement. So if I want to mirror that over, I'm going to create a negative 0.382. So this will give us the first extension to the upside. And that is all the way over 8,000. Now, when you're sitting here at the mid 7,600s or 7,500s, that seems like a really long way to go. And on the chart, it looks like a lot. But remember, as we're getting these higher numbers, the percentage it takes to get up there is less and less. So that is still just the same distance as this retracement to the zero line, just kind of flipped over, right? So it only took us from April 23rd until June 1st to get there. So you're talking, all of May and 1 week of April. So basically 5 weeks. So it can happen pretty quickly. Okay. So that's just one of the mechanisms you're going to be seeing here a lot. And I'm actually going to go back and use these extensions to show you how it's already happened in the past. So let's take a look now at the NASDAQ composite. Now this is going to be one of your crazier charts. Same situation though. You get the big rally, and then now we have a series of higher lows and lower highs, and we're interacting with this 50-day moving average again. So it's deja vu. But what I want to do here is now let's use this low from April. and extend that to what was the previous high. Okay, this sort of 24,000 level. And would you take a look? We had that queued up, that 38.2% extension. And that's basically where the market topped out here. Pretty crazy stuff, right? So what that tells me is that that was resistance, which obviously it was, and we'd be coming down looking for support before we get back up. Now that support can happen in a number of different ways. These moving averages provide that, and we've seen that. So maybe that was the support that we needed to keep going higher. But if the moving average isn't enough, then you basically need that previous high. So that's something I'd be looking for. Just like I was on the S&P 500, I'd be looking for a retrace to that level before the buyers really step in and can help this thing out. Now, I'm often, when I'm using these, I scrub it with this relative strength index. And I look for times when it's oversold and it reaches one of these values. And that was textbook in April. So I'm gonna move this backwards just to make a little bit of sense of it. And you can see that going back into April. Actually, let me fix this a little bit. This will fix the numbers. And you can make exact numbers here too. So if I take my cursor and I go over, I find the low here. So in this case, I see 14,784. And when I double click here on coordinates, I can go 14,784 and get the exact low. And then I can do the same here and get the exact high. 23,901, 24,20 essentially. So 24,20. So we're going to change this to 24. Well, it was 1999, right? I just said 20 to make it easier, but there you go. So this is going to give us the exact levels, which you can always go back and tweak. So we got very close to that high, right? Very close to that level. Anyway, so as the index came down and approached that key support level, we were also oversold on the RSI, giving you a pretty good buy signal. Now, people are going to be out there and say, hey, wait, but there's a little bit of a gap and yada, yada, yada. Well, I'm sure here we're looking at the spot index, meaning that cash index, and what's happening during the U.S. session. I could pull up the futures and I can almost bet you that we ended up wicking and touching that overnight, during the European session or something like that. Plus, it's never to the exact penny, right? But we're talking about areas where there's potential support, areas where there's potential resistance. So keep that in mind before you start naysaying the pseudoscience that is technical analysis. Anywho, so that's the case with the NASDAQ composite. Pretty interesting that we're seeing that come up and barely touch that. Two commodities that I want to key in on here. The first being crude. Obviously, this was in the news a lot because of the situation happening in the Middle East. For me, this was a good pulse on how the overall sentiment is with regards to the war in Iran. Okay. So when sentiment was bad and we thought we were going to be stuck in this conflict forever, that's when you saw oil rally immensely. As it started to get better, that's when you saw oil sell off. So just like anything, you get these overreactions in the market. And I think that intraday wick close to 120 was definitely an overreaction in the market. How do I know? Well, because we never got back up there, right? And then the subsequent peaks were lower and lower. And now we're working off a fib here, 78.6% retracement of that move. And here we are down under $70, but you're also way oversold on the RSI. Honestly, I'm looking for a bit of a bounce, and not even a bounce that is a huge change in the sentiment, like I was saying before with the war, purely technical. I could see a bounce here at 68.76, getting up to that $80 level, retesting this sort of bottom wick here and coming back down. And interesting that that bottom wick came and hit that 61.8 before going higher. So you can see how this oil, from a technical perspective, really loves to bounce within these fib levels. And since we're at one, I'd be looking for a little bit of a bounce. But if you want to be bullish on the U.S. economy, look, this is something to look at. I'm drawing these. I get stuck with the cursor sometimes, and I screw it up. There we go. All right, that's crude. The last thing that I want to touch on is gold. And how the mighty have fallen here. Look, I have fibs from years ago that I had back in here. But this time, what I really want to focus on is just these sort of swing lows for gold and the moving averages, because they really came into play, as well as the relative strength index. So we get up to 5,600, never quite get there, and now you have a series of lower highs, definitely in a downtrend. You got the 50-day moving average providing lots of resistance along the way down. And now you have the dreaded death cross with the 50-day moving average crossing underneath the 200-day moving average. Now, I really don't put much faith in this death cross, because it's been my experience that they usually actually happen more at the end of these negative cycles than at the beginning of them. Because you see, this happened so late, and gold is already finding support at 4,000. So you also had another oversold RSI. Similar thing happened when it wicked down to the 200-day. So right now, with this multi-day support at 4,000, I think you get higher. It's going to retest this 50-day moving average. Depends on what happens there, which way it'll go. We'll see when we get there. But overall, I think that the really nasty dip in gold is sort of done. And now we can work our way out of that. And again, gold, if you think of it as a world reserve currency with zero yield, then it should make sense that this is inversely related to interest rates. Okay. So if interest rates go down, that should be good for gold prices. If interest rates go up, that should be bad for gold prices. But that relationship's sort of decoupled, because we were worried more about inflation outpacing things than just where the rates were. Okay. So now we have a situation where, yes, rates have been coming down and gold was under a little bit of pressure. But when you look at the grand scheme on the 10-year, if you zoom out the picture, we've sort of been stuck in this range from the high threes to just under 5 since, mid 2023. So when you have these range bound markets and something as large as the bond market, a lot of the correlations are going to break down. And that's what we've seen, is those inverse relationships with gold and the 10-year have sort of broken down because of all the noise in interest rates. They haven't picked a direction, and there's still a lot of uncertainty in this. We're not sure exactly what's going to happen with the new Fed chief. How is he going to be? How dovish is he going to be? How hawkish is he going to be? How much is he going to be influenced by the president? We know what happened in the previous regime. There really wasn't much influence. So we're hoping that it can maintain its independence, the Fed, that is, and things can continue to get clearer, because right now we're still pretty murky on the interest rate front and what we're going to do. All right, folks, that's my analysis for the day. Thank you for spending the time with me, Dave Bartosiak here, editor of the Blockchain Innovators, Surprise Trader, and Home Run Investor. Thanks, and have a good day.